The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's discuss then limit orders. A limit order is an order placed at a predetermined entry price. It allows the buyer or seller of a financial instrument to choose entry prices should the market move to such a position. So we have two different examples here. We have a buy limit order and a sell limit order. So what do they do, guys? Why would we use these orders in the market? Well, of course, they have different advantages and disadvantages. Let's start with the buy limit order. Okay, the order is placed below price and the price then goes up. So let's just discuss this for a moment. We are trading the what should we choose? Should we choose the oil market just because it's quite known to us, guys? Of course, we'll use the oil market. So we're trading oil at the moment. Let's say the oil price here, WTI is, and we'll choose to annotate it on the left-hand side of the screen here. The oil price is now at $70 per barrel. But what happens is we see that bounce off a level just at our 70 level. Okay, the market just flutters around this level for some time. So here's the trading, and then we get it reversing here with the candlestick trading to the downside. Okay, now effectively at this point in time we want to get long the market, but we think we can get it at a better price. Perhaps it's trading down strongly, and the last level was where it started to consolidate here was like this, was at 65. So what we would simply do is say, I believe the market is going up in the long run. I don't believe I should buy it now. I think it's starting to trade down. I'm not sure how far it's going to trade down, but what I'd like to do is not take advantage of the trade to the downside or the shorting of this market. Is effectively I want to be long this market. That is my complete directional bias, but I can get it at a better price. I can get it at $65. The market trades down. I place, of course, my pending order, my limit order, excuse me, at $65. If the market trades down at 65 and touches the 65.00 mark, I'm going to get this trade where the market bounces, of course, and trades to the upside. I'm now long the market. Of course, the market could continue to trade down to 64, and I'm long from 65. However, that is the risk you take. But effectively, you're looking for a value trade. That is the same with a sell limit order. So what you're looking for is, you think the market is overvalued, but you think it has more steam. The market is potentially going to trade up for another day or two, and perhaps you might not even be at your trading desk at that time, so you'll use a sell limit. So let's say I'll try and interact with this sell limit order here we have on screen. Let's just say the market is trading in around, let's use the FTSE 100, we'll say 7,600, roughly around current price, but we're now at 7,700 and around 20 this morning. Yet we see the market start to trade here. It's trading up, and this is our 7,800 level. You think we can get a sell because this is the all-time high, say, in the FTSE. So the market trades over the course of the next day or two and actually trades up right to that level. We get our order placed at 7,800. We get the trade as the market touches our price and perhaps trades through it a little, and then it trades to the downside. Okay, effectively we haven't chosen to sell the market here at price. We have chosen to place a sell limit order at a specific price. That is our selling price that we like to be short this market at. Now, of course, if the market does not trade up there, well, you're not going to get the market executed, the market trade executed. Okay, so there are advantages and disadvantages to using these orders, and we'll discuss that in a lot more detail throughout. So let's move on then to the difference between, now that we've discussed some of the pending orders and discussed limit orders. Well, what are the differences between these two orders? Of course, Well, as an example, for a stop order to be executed, the market must trade through your order price. For a limit order to be executed, the market must retrace back to your order price. Okay, so can anyone think of the key word that really distinguishes these differences in these two orders? I'll give you a clue. For a limit order to be executed, the market must retrace back to the order price. Okay, so we know that it's retracing, the market's moving back to a certain level. For a stop order to be executed, the market must trade through your order price. Volatility, okay, some answers coming in. Jerry has, of course, momentum. That is the correct answer, momentum. So, of course, think about that logically. If you're looking to use buy stop orders, you are looking to follow momentum in that price because it has to trade through, it has to trade the market continuation of a trend has to trade through your order to be executed. So you're looking to follow price momentum. Momentum leads price, okay, as a general rule of thumb as a technical analyst. So there are serious advantages to using these stops in the market. Whereas again, some advantages to the buy limit is of course markets are volatile. You will see a level of retracement. You know, they don't trade in a linear fashion, of course, and that you have a specific price that you'd like to get long the market at. Okay, so very, very different in their objectivity, of course, and very different in their structure to actually get executed trade in the market. So let's discuss then profit limit orders. Of course, these are different than limit orders themselves. They're simply profit limit orders. A limit order is like a stop order, except it establishes a predefined exit for profit. Okay, so alternatively, like a limit order, guys, where you're trying to enter the market, you need to actually be in an open trade position to place a profit limit order, just like you need to be in an open position to place a stop loss order. Okay, so let's look at the example. We buy 10,000 euros or 0.10 lot of euro dollar at 124. We place a limit order at 125. The difference is of course 100 pips. The potential profit is of course $100. So that's our profit potential and our target. And of course, it's just a function of the trade size, guys, with the notional trade size to reiterate on previous lessons. So effectively what we're looking to do with this market is to place a trade. We're looking for a 100 pip winner. Let's say we enter, let's go through some of the analysis that we've went through. We enter the market using a pending order. So let's discuss a trade in its entirety. The market is perhaps at 12379. Okay, we use a pending order at price here at 124. Okay, and then we use, if that obviously is executed, we'll use our take profit or our profit limit order here at 125. So that's very simple. We could of course see the market trading this level of price consolidation like this, and perhaps this price could be our stop loss just below our 123.79 point, because that's where the market was trading at. That's the last corrective low. Then the trade is placed like this, and we actually get the trade if the market moves up, of course. We get the trade placed there and executed, and the profit target is of course at this level here. So if the market trades up to that level, we'll take our 100 euros, $100 profit. Okay, so quite basic in its analysis, and again, simply looking to capture profit in the markets. One of the objectives to this is of course that you can actually look to capture profit when you're not at your trading desk, and sometimes markets spike, of course. Let's say you're looking for a 30 euro winner, but you think there might be a volatility in the markets. Well, you could simply place your your profit limit order to a $100 winner, and if there's a crazy spike in the market, you could actually capture that. So let's talk through the structure of these profit limit orders in detail. Limit orders allow the trader, of course, profit limit orders allow the trader to outline a predefined profit target. Profit can be captured when the trader is not actively trading, like I suggested. Limit does pertain a focus on limiting profits, and that's a shortfall to running winners, guys, which is Not something that we'd focus on. Of course, we prefer to try and run our winners and cut our losers short, but do bear that in mind that they have several advantages to the profit take profit order or limit order, and they help traders to focus on a definite amount of pip gains. So there are some traders who say, look, I'm looking to, this is how I trade, this is my strategy, I want to lose 25 pips, or I want to place my stop loss at 25 pips, and I'm looking for a 60 or 75 pip winner. Okay, so that's effectively what we're trying to do. Entering the market, of course, as well. We're attempting to enter the market. Do you have a directional bias? Does your technical analysis support your trade? Okay, so these are the questions you'll need to scratch your head and ask yourself before looking to enter these markets potentially. Do you have a directional bias? Do you want to become a buyer or a seller? Does your technical analysis support your trade? Do the fundamentals support your trade? Are you able to enter the market at a technically significant price? Is this risk on the trade at an acceptable level? So are you taking 1%? Are you taking 2%? Or are you potentially taking too much risk, perhaps 10% of your account on this trade? Not advised. Are you able to manage the trade with confidence? Okay, are you able to manage the trade with confidence? Okay, so very, very important, very interesting indeed. These are the questions you should start to ask yourself as a trader. Now that we're thinking about becoming an active trader, before we enter these markets, we can go through a little process in our heads, okay? And are you able to manage the trade with confidence? If you're taking too much risk, I would argue no, that is not the case. So they all feed into each other, and these will establish your own rules and thoughts about, developing your own trading strategy, guys. So now that we're on to trade management, let's walk through a couple of trades. Let's discuss how we can effectively use the skills that we have learned over the course of this course to effectively get involved in these markets, to manage the trade positions, to effectively become traders, guys. That is a nitty-gritty. That's what we're focused on doing. That is our objective, okay? Trade management. Well, trade management is not only about placing a stop loss. So we know that, okay? We know that it's not just simply about saying, I'm getting long this market now, I think it's going up, and here's my stop loss there. No, we know that we can manage the position, we can move, we can mitigate risk, we can capitalize on more risk, of course. If the market is moving very strongly, we could potentially look technically to get long that market again if we're long. So there's many things we can do to maximize performance. It's not only about placing the stop loss, risk management. We must manage profits as well as loss. We've discussed that in a lot of detail, of course. Your ability to book in profit is your ability to become a successful trader. Does that make sense? I mean, that's very obvious, but your ability to book in profit must be managed. Okay, so trades management is as much about booking in profit, mitigating risk, than simply placing your stop losses. Good traders constantly revise their trade positions as new information becomes available. So we are looking to constantly revise trade positions as new information becomes available to the market. This doesn't mean that it might be, fundamental news to the market, to Bloomberg.com or to your CNN, or Mario Draghi, the ECB president, says this. Not necessarily. It might be something where, well, technically, the next candlestick we think we're on a nice bullish trend to the upside. Unfortunately, the next candlestick shows us a reversal signal, so a hanging man, a bearish hanging man. What we might look to do there, guys, is simply take profit. Sometimes I like to ask myself the question, if I wasn't long the market at this time, would I like to get long the market now? Considering there's a bearish hanging man there, a reversal signal. And the answer is no. So if that's the case, why wouldn't you look to take profit? New information has become available to the market. Okay, so bear this in mind. We aim to monitor risk whilst allowing the potential to stay in winning trades. Okay, so always allowing the potential to trade and to focus on making as much money in winning trades as possible. And that is, of course, one downside to your profit limit orders, which we've discussed. And be resolute in loss acceptance. Be absolutely resolute in your loss acceptance. Okay, just be resolute with it, guys. Know it's part and parcel of the game of trading. Know that there's, you know, several risks involved in trading these markets, but look, it's part and parcel of the game. We've discussed that. Be resolute. Just be comfortable with taking small losers. You know that you can trade over a period of a week, 2 weeks to outperform the markets. That's fine. Let's go into the practicalities, guys, of trade management. And what we're going to do is walk through several trading opportunities here. One being, one being a very, very focused opportunity of really how to take on too much risk in a market, how to trade well. So bear with me, focusing on this the next few slides here as we go through trade management. I want to show you how to trade and how not to trade. And of course, it's all going to bring into question your level of greed, your level of fear, your level of objectivity, your level of confidence, your level of trading strategy, your level of risk. All of these things together makes up a trading strategy and a human trader. Of course, you know, we're actively getting involved in these markets as our own economic agents, trying to decipher which are good and bad trades. So what we have here, guys, is the US Canadian dollar. What we have is a technical support level just holding up the market at this point in time. And the question is, well, how would we like to trade this market? Okay, so we have an entry. We have a technical entry at this candlestick here. Okay, so a nice break from previous highs potentially here. We've just looked to give it some room, and we've effectively made the trade at this price. We'll call that trade 1, and we are now effectively long this market. What is the first thing we'll do, guys? So I'll ask obviously the students on board here today, what is the first thing we do when we get long this market? Great. I can see the question and answer section is being flooded with stop loss is the correct answer. We place our stop loss. Okay, that is effectively using risk management upon entry. Then what do we do? Well, we make a profitable trade. Now, we might, of course, look to hold this market for longer, but given this is a rejection signal, which I discussed, let's say, for example, we get out with this candle here as the market continues to move or potentially moves to the upside. This candle here in the middle might have just stopped us out as well. So we've taken a winner off the trade potentially, but we've seen that this is a level of support and resistance prior, okay, and that the market moves back down to our support and resistance. And effectively, if you can see, guys, I'll just like to move that back. It actually gives us an entry point right at a long entry point right at the same level where we decided to get long again. And you can see the candlestick structure is just beautiful. Okay, right, this candlestick where I have my small green dot there, it gives us the opportunity to actually get long right at that point, because the market trades down, albeit quite slowly, quite bearish towards it, but nothing too crazy. Just retraces back to the level and bounces right off the level with a small bullish candlestick. Okay, it's almost an indecision bullish candlestick. So effectively, naturally, we want to trade the support level. It's a floor in the market. It is holding the market up. We get long again, and potentially we get another small profitable trade, although it's not a great trade, of course. Gives us perhaps 7 days of volatility. Small profitable winner. But that's okay. We don't always get the money trade. Excuse me. What we do then is, well, naturally, the market comes back down to our support level of resistance, and we're going to ask the question, does the support level hold up right at this level? And you can see with the candlestick structure, of course, it does. It just gives us a nice entry just above our support level. So, of course, what we want to do is get long again. We're going to make the money trade. And we get long again at price 3. So just think, sit back for a moment and think how psychological these type of trades are. You know, how our level of confidence in the support level is building, and how we're starting to develop a level of greed to our trading, to be honest. So then what we do effectively is we get a nice winner up to relative highs, and we know, well, this market might not break the highs. If it doesn't, we'll, let's say, move our stop loss into the corrective low here. Doesn't break the highs, very strong bearish candle to the next day, but we get a winner at these prices here around these highs, so that's great. Okay, there's our W. So then guys, what we're looking to do is remain objective to the support and resistance level. We then look for opportunities, and again, look at this opportunity right here. It rejects the low, it rejects breaking the resistance level, closes above the level, giving us a lovely buy from the high of this candle. Okay, so we get long the level again, and guys, this is just super. This is a free money trade. So this is effectively giving us 4 winners from this level again. You know, the next time this market trades down here, I'm going to hit this. I'm going to increase my trade size. I'm going to really go for this. Okay, so effectively we'll call this trade the Fantastic Four because we've had 4 fantastic winners. What I'd like to ask here, so just think about this guys, is we have just had 4 winning trades at the same entry price. What are we likely to do? What are we likely to do next? Perfect. Everyone's on the same boat this morning. So effectively what we're doing is we're looking to make the same trade. It's a natural instinct. We know that the level is holding up. However, one thing I would like to point out is it's not the best choice. Now, why might that be? It's because, well, guys, the market is just trading down with bearish candle after bearish candle after bearish candle the whole way through the level. It doesn't show any reversal signals like we had in 1, 2, 3, 4, or sorry, 2, 3, and 4, let's say, from the level, and it trades straight through the price. But it's okay. It's not. If we want to remain objective to the level of support and resistance, guys, it doesn't give us the best technical setup. But let's say we do, and we trade with the support and resistance level. Effectively, we have our stop loss in place, but the stop loss breaks down. Okay, so we're likely to buy. We're likely to go long at that price. Of course, that's what we're likely to do. The market breaks the level and continues to trade to the downside. Now that we've potentially had 4 good winners in a row, we have literally seen this market break to the downside. We are a little unsure. We have a little moment of greed in our trading, saying we don't want to give any losing money back to the market. We want to, of course, capture as much profit as possible. Let's say we're just confused where the stop loss is, and well, we make a decision, we make a judgment call. We remove our stop loss, guys. We are greedy. Okay, so this is not what we want to do as traders. This is not how we like to focus on trading these markets, of course, but effectively we see this as a free money trade, guys. Our emotions are overtaking the market, what the market is telling us. The resistance level was the reason why we were trading this market, but perhaps because we've had 4 consistent winners, or even 2 of those consistent winners off this level, we're sure that this is just going to bounce back up from the level. It's just a bit of volatility. And perhaps we've actually had 2 or 3 of those good winners in a row, and now instead of 3 1% trades, we've taken a 4% trade on this market, on this final straw. So the market trades to the downside. How are we feeling at this point? Our emotions are, of course, not feeling very good. Okay, so we've bought the market. The next thing we do is buy the market again as this market moves down. So this is not how we trade the markets, guys. This is poor discipline. This is very poor risk management. And this is effectively just telling the market, well, I don't care what you're doing. I'm not going to be wrong in this trade. This is terrible risk management. Then the market unfortunately continues to trade to the downside again. What you look to do is buy that market again, hoping that the market comes back, hoping that you can get a big winner of this. You've invested so much in this trade, and now at this point you're going to say, well, look, I'm invested in this trade. I'm really invested in this trade. The market moves down again. You've effectively bought the market again, and now you're saying, okay, this trading to me is a zero-sum game. The market's going to come back, and when it does, I'm going to be long these prices. I'm going to take a whopper winner, and then I won't make this mistake again. Okay, so that's just how I'm going to trade. Well, that when you've made these decisions yourself, that is effectively when you can say goodbye to your trading strategy and, of course, to some of your account balance. So that is not how we trade, of course, and effectively what happens in this particular trade is the market trades down again. You feel the pain. You can't handle the pain. What was a 10-euro loser is now a 300 or 400 euro loser, and you're understanding why you don't average in what this market is doing. It's so unfair, you're going to curse at the market. But look, this was all as a result of your trading decisions. Is it still a free money trade at our first entry price? No, of course it is not. How are we feeling? How are our emotions feeling at this point? Very poor. We have totally thrown out any trading strategy that worked. We have overcompensated in risk. We have neglected our stop losses. So many different things that we have effectively done very poorly on this trade, and effectively given a lot of capital back to the markets. So guys, take this on board. Please take this on board. This is not something anyone on any of my lessons will ever be doing, I hope, okay? Because it's very, very poor risk management. This is how, you know, for any of you guys who have heard stories of beginner traders blowing up their accounts, they gamble in the markets like this. This is close to gambling. This is not trading the markets, okay? So very unfortunate trading circumstances there. Let's move on. Previous example then is a prime example of how novice traders blow up their trading account. The process of repeatedly buying a falling market, or by the way, repeatedly selling a rising market, is called averaging in. It is a recipe for disaster. It's a recipe for disaster, guys. The moment you decide to take outrageous risk is the moment you have ultimately decided to give all your money back to the markets, whether it happens in the next trade or later. Okay, so you might get away with it. You might make a good, profitable trade on that particular trade if it comes back. However, of course, that is not likely to be the case. Of course, you might get away with this one. The next one, you will burn your account. If you do not follow proper risk management practice, there will always be one trade around the corner that will get away from you. Okay, and that is not how we focus in on trading these financial markets. Okay, so I'll leave you with that, guys. I wanted to go through a really, really poor trade setup to actually exemplify trade management to you, because we discussed how to manage trades, to move stop losses. Well, first to place stop losses, to use different order types, then to move those stop losses in accordance with how the market is trading to mitigate risk. Again, if you do want to give some room to the trade, of course, that is fine. But if the market is 200 euros on side and your stop loss is still at -20, well, I don't know why it would ever be there. That is not mitigating the profit that you've already made in the market, but you haven't made that profit until it's reflected on your account balance. So I wanted to finish off with that trade example to show you how not to trade and how never to take those outrageous risks in the market. So that brings us to the end of today's webinar, of course, webinar 7 with the beginners trading course. Very enjoyable indeed. What did we discuss today? Well, entering the markets with different order types, trade management, of course, in a lot of detail, and how not to trade these markets, how not to take these risks, outrageous risks in the market. It's all about consistency, guys. I know I keep harping on about consistency, discipline, patience, but that is the skills that you're going to need to develop to become a profitable trader, and that's what we all want. We all want success over a long period trading these markets. Over such a long period. Okay, how not to trade? We'll focus on your, stepping into the markets, and of course this focus of this lesson is becoming an active trader. Sometimes you get to reflect on how not to trade. Will of course help you, as a beginner to avoid those common pitfalls from beginning trading accounts. Okay. In the next webinar, of course, will be the final webinar of this beginners trading course, of course, webinar 8. The workshop, the practical workshop lesson, will be completely applying everything that we've learned throughout the beginners trading course, including some early technical analysis with support and resistance, ascending triangles, things like that. We'll be entering the markets with different pending orders, market executions, placing stop losses at different levels, trading different time periods, trading different asset classes across the commodities, the forex markets. We'll be looking at how we analyze candlesticks and then looking to get involved in some trades. So it'll be very, very enjoyable indeed, practical trading application on our final lesson, of course, before moving on, hopefully, to becoming an active trader as beginner traders yourself, or potentially going on to more education, hopefully with us here, or both, of course, with their education here at Forex.Academy. Okay, just some comments coming in thanking me for the lesson. That's fine. So look, what I'll do is let you go for the day. Good luck trading the markets, of course, today, and enjoying some more of our education throughout the day. Of course, it's ongoing here at Forex.Academy. So I'll let you go. Thank you from all of us here at Forex.Academy. Thank you for joining us. We'll see you next time. Bye for now.